Real solid start to the week that included a lot of rotation in the market. We had value stocks, we had the Russell, small caps breaking out. Tech got a little choppy, but the big move was in the bond market alongside the dollar, some attributing it to the appointment of Scott Bessent to the Treasury Secretary position. But I've been looking for yields to cool off now for 2 weeks. It was November 14th here in this segment that I started kind of hedging my red light on bonds a bit by saying it's likely that the curve is probably going to get pinched, just due alone to the reliability of the economic data, which has been solid, and the fact that inflation numbers were plateauing and not really going down anymore. That suggested the curve might get pinched and long yields might slow down if the Fed is forced to reconsider December, which right now the market is still saying it's more likely going to happen, a 25 basis point cut than not. But there might be a few things under the surface that are obfuscating that a bit. So risk radar, light's been red on bonds. I want to turn it yellow now because not just of today's move, but because I've been looking for this for a couple of weeks for yields to slow down. So let's go into the chart real quick, look at the spread and the way 10s to the 2s are trading in particular to get some insight. Usually where yields go, the dollar goes as well. But the dollar showed a little bit more springiness today, and the greenback, I think you could chart up to some more technical causality for today's move. So firstly, bonds, 10s to the 2s. All right, generally a pretty big move lower here in the 10s. They've been, for the most part, moving alongside, but the difference here is that last week on Friday, the 2s are in the blue here. We had the 2-year basically at its high. Okay, we made a higher high for yield, but the 10s and the white didn't. The 10s, the white line here goes back, we kept getting stuck at 445. So the bottom line is the 2s are staying a little bit more elevated than the 10s. That's the first thing that does show up in the yield curve, which is now getting pinched. So this little drop off here is pretty much what I was looking for. November 14th is when I said it would probably slow down. That's this candle right here. So pretty decent little timing here, looking for the rate kind of unwind to some extent. Now, this is a 3-month chart that shows you we were getting that steepening, which was a positive thing, a generally good message, some of it coming from term premium and bonds, so there's some truth to the notion that maybe there's some policy getting priced in here, and so perhaps Scott Bessent's appointment does take a little bit of that out. If he's going to try and push back on the tariffs, then maybe there's some implication there, but here's the thing. That is such a complicated analysis. For example, what tariffs would do to the bond market. There's so many different ways you could argue it. Really, it's not that cut and dry, especially when you think about how in the past administration we got tariffs, but didn't really have a big impact on bonds. It also might just be negotiating tools. I think what's more interesting is basically looking at the dollar when it comes to tariffs. I think the tariff stuff is more relevant for the dollar because if you do put some pressure on other economies relative to us, then that's just going to skew that dollar even more bullish. But what's interesting today is that the dollar event, even was a big drop in the dollar has been ripping here. So I think that kind of casts a little bit of skepticism on the notion that this was all about the Treasury pick today. The other thing, too, with the dollar is that these were pretty important areas of resistance that we blasted through. So it seems reasonable that like 107-ish, the dollar might get a little pushback. So even though I'm not going to change the light on the dollar for now, you want to keep an eye on that too. If yields stay under pressure, then you expect the dollar to stay under pressure as well. But generally, the expectation that the Fed probably doesn't need to cut right now in December, that alone should start to flatten the curve a bit. And that's that butterfly effect I talked about, which it might seem a little bit counterintuitive. You go, oh, wait, the Fed's not going to cut. Why does that keep yields limited to the upside? Well, because the market has been moving, pushing yields higher since the Fed delivered its 50 bips. So just right there, cuts have equated to higher yields right now as the market was expecting maybe some positive growth and some sticky inflation. So if the Fed can't cut anymore, you limit some of that juice for the economy, long yields slow down a little bit, curve gets pinched.